Hi guys, thank you all so much for joining me this morning. For those of you who don't know me, I'm an economist from CoreLogic, from the CoreLogic research team, and I'm going to take you through the property market update for today. There's been quite a bit happening in the market, so there's a lot to cover. Now, obviously, you guys are the experts in your own respective markets. This session is sort of intended to give a bit more of a macro view of what's happening within the market. And some of the factors that have been driving some of the trends that we've been seeing in the markets as well. Now, I know that we do have agents on from sort of all over Australia, so I have tried to include some different regions, but if I haven't covered off your specific region, please feel free to reach out and we're more than happy to email over some stats for you as well. Also, as Tanika said, if you do have any questions, please feel free to drop them into the chat box and we'll try and get to them at the end. Before we do start, I did want to put a little disclaimer on today's presentation. So as you guys probably know, CoreLogic releases its latest monthly data on the 1st of the month, and it is currently the 31st of the month. So the rest of the team is hurriedly off compiling all of those numbers in the media release now. But unfortunately, those fresh stats just weren't available to be included in today's presentation. I have taken a little squiz at some of the preliminary numbers, so I will try and include some of those where I can. But largely speaking, a lot of the trends that we're going to be talking through today are the same, but maybe the number or the magnitude has changed just a little bit. I just didn't want you to see some new numbers in the newspapers tomorrow and say, Caitlin lied to me. So I just want to point that out now ahead of time. So on that note, let's jump into it. Sorry guys, technical difficulties. So starting off at the very, very macro level, this slide here just summarizes some of the high level figures that are important to the Australian property market for households. So in June, CoreLogic estimated that the total value of Australian residential real estate came in at $10.8 trillion. So that's greater than the combined value of commercial real estate, the ASX, and Australian super funds. So quite an important asset class. And we have seen that total valuation rise quite quickly. So we would expect with values continuing to rise that maybe we might see that tick over the $11 trillion mark before the end of the year, which is pretty astounding when you consider that it only ticked over the $10 trillion mark in June last year. So quite a strong increase in total value of Australian residential real estate. So households continue to make up a fairly significant portion of household wealth. Around 56% of all household wealth is in the residential real estate asset class. So quite an important asset for wealth creation, as well as being an important asset for housing security into retirement. Looking at annual sales, we've seen some relatively strong annual sales activity with around 590,000 properties transacted over the last 12 months. And that's up from a previous decade average of around sort of 485,000 properties. So a bit above average activity going on in the market, which is really quite interesting when you do think about some of the perceived headwinds that we've been seeing in the housing market, including those high interest rates, the affordability challenges that we've been seeing, more recently, some of the more challenging economic conditions that have started to emerge. So arguably, the trend in sales activity is definitely one to watch over the coming months. And finally, we've got the gross value of sales over the 12 months to April, which came in at around $460 billion. So now that value has declined from, say, the peak of the COVID period when we were seeing incredibly strong gross value of sales when properties were selling incredibly fast. But at the same time, the value of those underlying sales has increased, so still quite strong, healthy value of sales. And if we do apply a 2.5% commission to those numbers, there is still quite a healthy commission pool for those sales at around $11.5 billion. So, pardon me. So I'm battling a little bit of a cold at the moment, so I might just take a sip of water. So looking at housing performance more recently, there's been two sort of major trends start to emerge over the past couple of months. So the first trend is one of resilience. So since for the past 17 months, we've seen values rising in spite of those tailwinds that I mentioned previously. The market's been quite resilient to what otherwise has been a fairly challenging set of conditions for growth. And that's seen values rise by about 8% over the past year, and it's added about $60,000 to the median value of your average Australian home. So the second trend that we've been seeing is a real diversity in the growth underneath that headline figure. So national values have continued to rise, but looking across the different cities, we're seeing a real diversity emerge underneath that headline, a real variance starting to come about. So looking at capital gains at the national level, this chart here shows the monthly change in the national values, as well as some of the macroeconomic factors that have influenced the housing market over time. From this chart, you can see sort of the COVID surge in values, where fiscal stimulus, incredibly low interest rates saw values rise by around 30% over the course of 2 years. You can also see the really sharp decline in value at the beginning of that rate tightening cycle, with values falling by about 7.5% over the course of 9 months. But by the beginning of 2023, the market had kind of gotten over the shock of rising interest rates. And we started to see a bit of a recovery start to come about in values, with national values actually reaching a new peak in November, and have since seen values rise to a new peak every month since. So about 7 months of continual new peak in value. So quite sort of a resilient market in the face of what is otherwise a fairly challenging sort of market. So what's driving some of this resilience? In sort of both the short and the long term, you can see that over the back series, values have generally been rising across the country nationally. And one of the reasons for that is that we simply don't build enough houses to meet demand. So over the most recent growth cycle, we've seen incredibly low listings levels at a time when sales activity is sitting sort of at or above normal, depending on the city. So that mismatch between supply and demand has helped support values at a time when most of your other market conditions should be pushing values down. Now, that's not to say that, the current environment hasn't had an impact on value growth. The high rate environment has definitely impacted growth, and you can see if you sort of narrow into this right-hand side of the chart. So I don't know if you can see my cursor circling it there. You can see that when we have seen those additional rate hikes over the past sort of year and a half, so in June and November, that has taken some of the heat out of the market, with that pace of monthly growth pulling back a little bit. At the beginning of the year, we did see a little bit of a resurgence in the pace of growth, a little bit of exuberance, and that's largely based off the back of people hoping, I guess, that we were going to get an extra rate cut in the second half of the year. But of course, that jubilance has now largely abated, thanks to sort of some disappointing inflation numbers, which I'll get into in a bit. And I don't have, unfortunately, it's not on this chart. Looking at tomorrow's numbers, it does seem like that monthly growth trend has once again eased and is a bit more evident that that jubilance that we were seeing at the beginning of the year has largely evaporated, with values set to rise by about 0.5%. So still rising, but definitely at a lower rate than what we were seeing. So before I move on to some of the divergence that we're seeing across the different markets, I thought I'd take a moment to discuss some of the factors that are potentially driving some of the resilience at a national level outside of supply. So because the idea that values are rising in such a harsh market is fairly novel, and it does sort of warrant looking at what's happening in that demand sector. So to illustrate just how unaffordable the market has become for most homeowners, my amazing coworker Eliza created this chart here, which shows the median house and median unit value in the orange and yellow, and what is considered a quote sort of affordable purchasing price for your average Australian homeowner over time. And that assumes, so to use data that we compile for the affordability report from ANU, and that looks at the average or median household income over time, and assumes that for most households, they don't want to spend more than 30% of their wage on housing. So extrapolating from that, when working backwards, we've been able to calculate what the affordable purchase price for a house would be if you were wanting to stick within that 30% limit. And over time, those trends, those measures have generally tracked in the same direction. But of course, when we started to see interest rates rise, this trend has diverted quite significantly. So the sharp upwards adjustment in interest rates has really severely reduced borrowing capacity, and the cost of debt has increased quite dramatically, which is definitely should be deterring people from purchasing in this current market. But as I mentioned, we are seeing still quite strong sales activity. So what gives? So from this analysis here, you can see that the average income is no longer sufficient to purchase the average house or unit in Australia. And some of the things that we think are contributing to this gap are listed on the right here. So firstly, it's highly likely that your average household isn't buying your average dwelling. So instead, we're likely seeing demand skewed towards the more affordable, sort of cheaper end of markets. So we're likely seeing your higher income families purchase properties in your more median markets, your medium income families purchasing properties in your lower quartile. And of course, that has the effect of essentially pricing out your lower income families completely. There is a bit of data from the RBA that does support this, suggesting that income brackets for people taking out new loans has been creeping up. So that does suggest that we are generally seeing your higher income families be more active in the market. But we've also seen a bit of a shift to to the more affordable unit sector as well. So people buying smaller dwellings in general. There has been a bit of a pivot towards the unit sector in recent months in growth, with units starting to outpace houses at the quarterly measure, which we'll also talk about in a little bit. So also people getting a bit of a helping hand into the market, so the bank of mum and dad, potentially some people rent vesting, although the numbers do seem to be quite small, still making up a relatively small portion of first home buyers. You've also got subsequent buyers who, thanks to the strong gains that they've seen over the COVID period, are less reliant on debt, as well as downsizers who generally, again, are less reliant on debt. So that's likely some of the things that are behind the demand side factors that are keeping values rising. So moving on to the other trend that we're seeing in the market, that's the trend of diversity. So while the national figure has risen by about 8% over the past year and about 1.7% over the past quarter, that headline result is hiding quite a bit of diversity under that figure. So this chart here shows the rolling 3-month change in dwelling values across the combined capitals. And you can see that over the past few months, there has been a real segmentation or a separation of growth rates across your different capitals. So Perth in the light blue is seeing some of the strongest growth across the country, with values up around 6.4% over the past 3 months. So that's a rise of more than 2% a month. Adelaide's up 4.7% over the quarter. Brisbane's up 3.7%. At the other end of the scale, you've got Melbourne with a quarterly decline of 0.6%. Melbourne's been one of the weaker performing capitals for a while now, with values only around 11% higher than they were at the beginning of the pandemic. Now, obviously, there's a couple of factors that have played into that. Lockdown's really hamstrung Melbourne's value growth over those early periods of COVID. They've also had some fairly unfavourable land taxes and landlord restrictions, which has hampered investment demand. But they've also seen a fairly healthy supply of new stock coming to the market as well. So it hasn't had the same supply limitations that some of your other states have had that has helped bolster value growth. Arguably, although Melbourne values have been lagging behind, given that it's had a healthier supply of new stock and on an affordability front, it's remaining quite, it's gaining a bit of an affordability advantage on some of the other capitals. Arguably, that's placing it in a good position for the next growth cycle for it to outperform them. So Hobart's also seen a relatively weak value growth. ACT and Darwin's also sort of mild growth trends. Sydney in the dark blue is quite an interesting growth trend to look at, and it really does sort of show some of the affordability factors at play. So Sydney typically does tend to lead a lot of markets in terms of growth, tends to be one of the faster moving capitals. And from this recovery, you can see that it had a quite sharp recovery in values in the early stages of this upswing, with quarterly growth peaking at about 5.5% this time last year. But as we've seen additional rate hikes with the June and the November rate hike, that has really taken a lot of steam out of the market and has seen that quarterly growth ease right back down to around 1.1%, where it's stabilized. So there's a number of reasons for this. Obviously, Sydney is your most expensive capital, so it does tend to be a little bit more sensitive to those cost of debt factors. So that's definitely been one of the factors weighing down Sydney's value growth over the past couple of months. Now, I don't have the chart for the regions on here, but broadly speaking, regional markets are following sort of a similar pattern to your capital cities. So regional WA, regional South Australia, regional Queensland, all leading the pack, with regional Victoria lagging behind and Tas and New South Wales coming in the middle there. But overall, the trend is one for diversity, particularly when looking at the annual level, with Perth values rising a staggering sort of 23% over the past year. By comparison, Hobart has seen the lowest annual growth, with values falling by about 0.1% over the past year. And now, diversity in and of itself isn't necessarily an unusual factor when looking across your different growth rates, but the gap has been widening over the past couple of months. So to illustrate this point, this chart here shows the range in annual capital city growth. So it's simply taking the highest annual growth rate among the capitals and minusing off the lowest growth rate, and looking at the percentage point difference between those two numbers. So at the end of June, taking the Perth result, which is 23.6%, minus the Hobart result, which is minus 0.1%, we get a percentage point range of around 23.7%, which is actually one of the highest we've seen in the past 10 years. It's actually almost bang on in line with what we were seeing at the beginning of the rate tightening cycle. So it's definitely widening. The range that we're seeing in growth is definitely widening. And that does typically tend to happen at an inflection point in the cycle. So the last time that the range of growth among the capitals was this wide was just as we were starting to shift into the last downturn as we saw those rates hike. So as, say, markets like Perth and Adelaide were still surging along, while Sydney was already in decline. So one of the reasons that we think that we are seeing such a fanning out in growth rate is that effect of demand being skewed towards the more affordable end of the market. Another way that we can look at how the composition of growth has changed among the combined capitals is by looking at these charts here, which again was created by my amazing co-worker Eliza Owen. So these charts break down the composition of growth. These are monthly growth figures for June last year on the left and June this year on the right. So remembering that the combined capitals measure that we look at is a weighted measure. So markets that are larger and more expensive do typically tend to have a larger weighting on that calculation. So even, say, a modest increase in Sydney can outweigh a range of declines across your other capitals. So this time last year, Sydney was leading the pack in terms of growth across the capitals. Values were rising at about 8.1% in June last year, and that translated to Sydney making up more than 60% of the combined capital growth across those capital cities. But if we look at growth over June 2024, it's a very different story. So now Sydney only accounts for around 33% of the combined capital growth, with a much lower monthly growth rate of around 0.5%. Melbourne's detracting from the capital city growth, but more interestingly, your mid-sized capitals, so Perth, Brisbane, and Adelaide, are accounting for around 70% of all capital city growth. So it's really highlighting the strength of some of these more affordable markets and arguably showing some of the weakness in demand across markets like Melbourne and Sydney. So thank you for sticking with me through some of that. I know some of those last slides can be a little bit dense in terms of explanation of what we're looking at. I promise the next couple of slides are a little bit more interesting, at least visually. This slide here and the next couple of slides show the 12-month change in dwelling values across your capital city suburbs. So you've got your falls in values in your red, your increases in values in your blue, as well as the sort of 10, 20, and 50 kilometre ring around your GPO. So like with the capital cities, at the suburb level, we're also seeing a fair amount of diversity, with growth being skewed towards that more affordable end of town. So my wonderful boss, Tim Lawless, recently did a LinkedIn post on the Sydney Latte line, or the Red Rooster line, whatever you want to call it, which is essentially just a diagonal line. If you draw a diagonal line from Hawkesbury to Randwick, on the north side of the line tends to be more expensive, the south side of the line tends to be more affordable. And you can see that growth has really sort of stuck to this trend. So your more affordable your more affordable mortgage belt areas have seen some of the strongest growth over the past year, whereas above that latte line, growth has been weaker, and in some of your more expensive markets in your, say, eastern suburbs, values have actually declined over the past year. So looking at Melbourne, you can see there's a little bit more red, particularly in that inner east and inner southeast market. So again, your more expensive markets, whereas your mortgage belt tends to be a little bit healthier in terms of value growth. As well as, interestingly, your inner city markets, they tend to have a higher concentration of more affordable units, which has really been bolstering growth in those inner city markets. Now, this one here doesn't really show a lot of diversity, but it does sort of illustrate that across the board, in markets like Brisbane, you have been seeing values rise by more than 10% across most suburbs. There's very, very few exceptions. Unfortunately, our colour scale doesn't really show. There is some diversity underneath this sort of blanket of blue, with markets in your more affordable corridors, like out to Ipswich, across the sort of Logan Gold Coast corridor, seeing some of the larger increases. But generally speaking, we are seeing a very strong rise in values across the board. And I know for me personally, being a Southeast Queensland girl and a Southeast Queensland homeowner, a blanket of blue does make me very happy. Again, looking at Adelaide, it's a very similar story. Blanket of blue, very strong growth across the board. And again, looking at Perth, again, wall-to-wall blue. I know that these last few slides aren't really super useful when looking at these markets from a sort of suburb level, but it does illustrate just how broad-based a lot of the increases have been in these areas. So before I move on to the regions, I did just want to touch on the differences between house and unit growth. I did mention earlier that demand has been skewed towards the more affordable end of the market. And that's happening not only across your more affordable cities, but also between your different property types. So units typically have a much more affordable entry point than houses. The premium for a house has actually grown quite significantly over the past couple of years to about 50%. So your median capital city unit is around $320,000 cheaper than your median capital city house. And so in a time when we are seeing reduced borrowing capacity, high cost of living, that lower entry price is definitely starting to give units a bit of an advantage. And that can be seen across most of your capitals here, with units now starting to show a stronger quarterly growth rate compared to houses. So moving on to the regions. So for the past few months, we've actually seen regional values outperform the capitals at the quarterly pace. So regional values rose by 1.9% over the past 3 months, compared to a 1.8% rise in capitals. So it's a very mild sort of outperforming, but this trend does suggest that maybe some buyers who, pardon me, so sorry, the joys of the cold that won't go away. So this trend here does suggest that some buyers that have been priced out of your capitals are looking a little bit further afield in hopes of finding sort of a more affordable alternative in your regions. Although looking at the numbers for July, it does seem like this trend has been fairly short-lived. So the July numbers does suggest that the capitals are now once again outperforming the regionals. So here we've got the rolling quarterly change in values across some of your major East Coast hubs. You've got Newcastle, Illawarra, Southern Highlands, and the Richmond Tweed for New South Wales, the Gold and Sunshine Coasts for Queensland, and Geelong and Ballarat for regional Victoria. So across these major regional centres, you can see in their growth trend that they have had some fairly similar trends, namely a massive upswing during that COVID period, followed by a pretty short and sharp decline in values at the beginning of the rate tightening cycle. But since then, a lot of your major regional markets have seen their growth trend shift back into sort of a fairly normalized growth cycle. There are a few exceptions. So the Gold Coast and to a lesser extent, Sunshine Coast have both seen a fairly strong rebound in the quarterly growth rate over the past year. So remembering back to that Brisbane map, which is a solid line of blue, that extended both up to the Gold Coast and down to the Gold Coast and up to the Sunshine Coast. So they've both seen fairly strong quarterly growth over the past couple of months, although there is starting to be some signs that maybe this pace of growth is starting to weaken. So it's maybe not quite as sustainable. And that's fairly understandable, especially when you consider that across these markets, values have risen by more than 60% since COVID. So as those affordability challenges are starting to set in, that pace of growth is starting to ease a little bit. So the Illawarra and the Sunshine, the Southern Highlands and, sorry, getting a little tongue-tied there with too many S's. Illawarra and the Southern Highlands and Shoalhaven are starting to see a little uptick in the rate of growth. So Illawarra is up about 3% over the last 3 months. The Southern Highlands up a milder 1%. And then at the other end of the scale, you've also got your regional Victorian hubs. So both Geelong and Ballarat have seen negative value growth over the past quarter. So moving on to sales and listings, they give us another insight into short-term sort of housing supply and demand. So we consider transactions of sales, transactions of properties to be demonstrated demand. So the amount of people that are willing and able to buy property. The other side of that coin is listings. So that reflects the number of people who are willing or really want to sell their property. So as I mentioned a little earlier, national sales activity over the past year has been tracking a little bit above average. So an estimated 509,000 properties transacted over the past year. So this chart here shows the annual count of dwelling sales across Australia over time. And from this chart, you can see the really strong uptick over the COVID period in sales transactions, with that annual count peaking at around 625,000 over the 2021 calendar year. Now, since that peak, during the downswing at the beginning of the rate tightening cycle, we saw sales activity fall by around 25%. And that's roughly in line with historic averages, the average decline that we've seen during other historic periods of easing activity. Down about 25% from the peak. But since it bottomed out in July last year, we've seen a fairly slow but sort of steady pick up in sales. So we've seen that the annual count in sales rise above the previous 5-year average, and it's now sitting around 5% above that average. The trend does look to be flattening out a little bit, which does mean that we could possibly be moving past a peak in sales transaction. It's definitely a trend to watch in the coming months, and to see how this trend holds up, especially if we do see, say, some negative shocks coming from maybe a potential interest rate rise next week. So definitely a trend to watch. So looking now at quarterly sales activity and comparing them to the value growth that we saw earlier, we can see that there is starting to be a bit of a correlation. So your markets that have seen some of the strongest sales activity over the last 3 months are also some of the markets that have seen some of the strongest value growth. So the table here compares the sales activity over the last 3 months to the same 3 months last year and the average of the same 3 months over the past 5 years. So that's just helping to control for some of the seasonality that can occur in sales activity. And looking across your different cities, your strongest cities are the ones that are seeing the strongest value growth. So Perth, with around 13,000 sales over the past 3 months, is seeing sales activity around 30% above its previous 5-year average for this time of year. Adelaide's up around 22%, Brisbane's up around 10%, Hobart, where values fell by about 0.3%, saw sales activity around 8% below its average. Sydney is still seeing sales activity holds below its average, which really reinforces that idea that maybe the more expensive markets like Sydney are seeing softer demand amid those affordability constraints caused by high interest rates. So that's then again reflecting in its weaker value growth. Now, Melbourne is a slightly interesting case. So sales activity across the city is actually tracking a little bit above average, so around 3.5% higher. Now, relative to, say, Perth and Adelaide, Melbourne is still quite expensive, but compared to markets like Brisbane, Melbourne's actually starting to gain a bit of an affordability advantage. So Melbourne and Brisbane have been battling it out in terms of its median value. And at the beginning of the year, Brisbane actually overtook Melbourne for the third most expensive capital. Brisbane now starting to sort of jockey with Canberra for the second place title. But with Melbourne moving back down the ranks, it does give it a bit of an affordability advantage. And given that we're seeing slightly above average sales activity, that does suggest that maybe buyers are skewing their demand towards that more affordable end of town and are seeing Melbourne as a more affordable alternative. But of course, sales activity is only sort of half of the puzzle. The other side of that coin is listings or advertised supply. So these charts here show the 4-week counts of national listings over time, with new listings on the left and total listings on the right. And in each chart, you've got 2024 in the dark blue, you've got 2023 in the red, and the previous 5-year average in the black dotted line. So throughout the year, the trend in national new listings has sat at or above average. And since sort of April of this year, it's been well above that previous 5-year average. And as of Monday, was around 8% higher than what we typically see this time of year. So that suggests that vendors have been quite active in the market, and vendor activity is quite elevated, with more people looking to sell than what we would typically see. So on the right, you've got your total listings levels. And from this chart, you can see that despite the strong flow of new listings coming to market, that total listings count has remained fairly flat. So it's still in line with the listings that we saw, say, this time last year, and it's still around 13% below that previous 5-year average, which again suggests that more sales are occurring than new listings coming to market. And that's really keeping a lid on supply, helping to bolster those values and seeing stock in some markets deplete. So looking across your individual capital cities, you can see that, say, markets like Melbourne, where prices are relatively weak, there has been, so in markets like Melbourne, you've seen a bit of an accumulation of stock. And that's in spite of that above average sales activity. And that's largely down to a really quite strong flow of new listings coming to the market. So around 23% above average new listings coming to the market, which has helped new stock accumulate, the total stock accumulate to around 15% above average. By comparison, markets like Perth, Adelaide, and Brisbane all have stock levels 30% or more below their average. And that's really reflecting some of the urgency in those markets and helping to push values higher at a time when most other factors would be pushing them lower. Pardon me. So the urgency that we're seeing in some of those cities can also be shown in the median time on market measure. So looking at your average time it takes to sell a property, so from first listing to contract date, it's no surprise that once again, Perth has led the top of the tables with a median time of market of just 10 days. So it's quite an impressive median sales time. And to put that into perspective, that means that over the last 3 months, this is a 3-month measure, half of the properties sold in Melbourne sold in less than 10 days. So quite a quick turnaround. This is followed by a 20-day median in Brisbane and a 28-day median in Adelaide. And these 3 markets have all seen that median time on market decrease compared to last year. And then on the flip side of that, of course, we've got markets like Sydney and Melbourne, where it's now taking that little bit longer to sell a property compared to last year. I'll race through some rental market updates, any PMs on the line. I did have a section on construction, but depending on time, might need to skip it. So these charts here show the annual change in rents by property type. The most recent upswing in rental values was predominantly led by your capitals and was predominantly led by the inner city unit markets within those capitals. So one of the reasons for this is the fairly swift spike in net overseas migration that we saw at the beginning of 2023, with the vast majority of the housing demand from new migrants flowing into rental demand, and the vast majority of those choosing to settle in sort of well-located central locations, which tend to be your inner city unit markets. So the annual change in capital city unit rents peaked at 15.5% in May last year, but it's since been easing amid those worsening rental affordabilities, as people have been priced out of rental markets and they don't have the same flexibility that buyers have. Renters can't go and take out a loan in order to pay that additional rental burden. So over the past year, we've seen that annual rate in unit rental values increases come off the boil and ease to around 7.5% over the past financial year. So looking across your individual capitals, again, that slowdown in unit rents is evident across most of your capitals, particularly your larger capitals like Sydney and Melbourne. But we're also starting to see that ease in Brisbane and Perth. Growth in house rents, on the other hand, has held relatively steady. We've actually seen maybe a slight re-acceleration in house rents over the past year. This is again likely due to affordability constraints. So people are maybe shifting demand towards the larger house sector as a way of sharing out that additional rental burden by forming larger households. So Eliza again did a fabulous piece on this recently, looking at rental value growth by bedroom count. And it does, this analysis found that rental growth has been favouring your larger properties. So it does suggest that people are looking for larger properties as a way of sharing that additional rental burden. Oh, sorry. But zooming back out to the macro level, we are seeing that it does seem as though we have moved past the peak in rents, in rental growth. So demand for rents is no longer strong enough to maintain some of the double-digit rental increases that we were seeing last year. And that's good not only for renters, obviously the renters will be very happy about that, but also for the inflation outlook. So housing makes up a fairly large component of the CPI calculation at around 22%, and rents, new housing construction and utilities make up that sort of 22%. So this chart here shows the CoreLogic measure of rents, which looks at median rental values, what a property could rent for at any given time, and compares it to the CPI rents measure, which is a measure of rents paid. So obviously there's a bit of a lag between what a property could rent for and what a property is renting for things like leases. So there is a bit of a lag between the two measures, but generally speaking, they do tend to move in the same direction, with the CoreLogic measure typically leading the RBA measure by about a year and a half. So given that the CoreLogic measure has moved past a peak in growth at about March last year, that does suggest that we should soon be moving past the peak in CPI rents, and that should help bring inflation down. Now, I did have a small section on construction, but I might just skip over it. It's essentially looking at the government's goal for a 1.2 million new homes, and just saying that approvals levels have been incredibly low over the past year or so. They've held well below their sort of decade average and well below the goal of around 20,000 dwelling approvals every month needed in order to achieve that $1.2 million new homes over the next 5 years. There was also a little bit on construction costs, which have been which have been holding relatively low. So we did see quite a strong peak in construction costs over the pandemic period, but they have started to come back down. They're still rising, but at a much more predictable rate than what they were during the pandemic, which should help provide builders with a little bit more certainty, and help them recover some of their profit margin. Yeah. So where to from here? Pardon me. So the number one question mark that still remains around the housing market is the outlook for inflation and interest rates. So the June quarter inflation numbers are being released at 11:30 this afternoon. Sorry, 11:30 this morning. Clearly I need another coffee. So they're being released at 11:30 today, and I don't think it's too melodramatic to say that they're probably going to be one of the most anticipated ABS releases of the year. Although I don't know if anticipated is quite the right word, maybe feared. So the monthly CPI indicators for April and May came in a little bit higher than was previously anticipated. They actually saw a little bit of a re-acceleration in inflation, and that does suggest that if that quarterly number does follow suit, it would put more weight behind the idea of a further rate hike at next Tuesday's RBA meeting. Now, the monthly numbers aren't complete measures, so we could be in for a complete surprise from the quarterly numbers. There are some components of the quarterly numbers that aren't included in that monthly measure. But if we do see that quarterly number come in that bit higher than the RBA are hoping for, that does definitely put extra downside risk on the housing market and the outlook for both values and sales activity. Some other tailwinds are sort of the continued softening in economic conditions. The unemployment rate has ticked up to around 4.1%. Mortgage arrears have also started to trend upwards, although from a very low base, and consumer sentiment remains near recessionary lows. On the flip side of that is we are still seeing the mismatch between supply and demand. And arguably, we're getting closer to what is likely to be a burgeoning undersupply in overall housing stock as the construction sector sort of continues to fail to deliver new or adequate levels of new stock to the market. So on balance, the outlook for values and activity is still relatively positive. The mismatch in supply and demand is still supporting value growth, although there are growing downside risks, particularly if we do see a further rate hike next week. So on that note, thank you so much for joining me, and I'll hand it back to Tanika for any questions.
Thanks so much, Caitlin. That was great information. So does anyone have any questions? No one's put anything in the chat box. No. Perfect. Well, if we could get a copy of that slide as well, Caitlin, we can send it around to everyone. And thanks everyone for joining.
Thank you all guys for joining. And if I haven't covered off on your region, again, please feel free to reach out via email, and I can send over any stats that I have for your region as well.